The 40-year debt cycle is not slowing down, and despite the fact that many people were very hopeful that this current administration would do something about the out-of-control spending and the debt spiral loop that we are caught in, what we are seeing is the exact opposite. First, let me explain what this 40-year debt cycle is. The government, over the course of about 4 decades, will lever itself up, increasing its own debt relative to the size of the economy that it can tax, in this case, the United States. And then for about the next 40 years, it will deleverage itself. Again, its debt load relative to the size of the GDP. And then for about 40 years from there, it will lever up yet again. And we are now at the point where the US government needs to deleverage again. And given the factors that I'm going to outline here, the deleveraging that we are looking at is almost certainly going to be an inflationary deleveraging. There are other ways to deleverage that are healthier for the economy and not as unfair for the average taxpayer. Inflationary deleveragings tend to help out the political class, the connected, and the already wealthy. And that is the direction we are going down again. This is the chart of the yield on the 10-year US government treasury bond. And you can see this chart is the inverse of this last one that we were looking at, which is the debt to GDP ratio. In other words, as the US government is levering up, interest rates are falling. And then once the US government has leveraged up as much as they can and they have to deleverage, then interest rates start going up. Keep in mind, inflation goes up along with this. And then the pendulum starts to swing the other way yet again once interest rates and inflation peak and the US government starts to lever up again. From there, interest rates start to fall as the government leverages up again until interest rates bottom out and the whole thing starts over again. The reason why nobody sees this coming is, number one, these cycles take a very long time to play out. And number two, while they're playing it out, it doesn't seem like it's that painful or there's any real danger in the future. Because for 40 years, from 1980 through 2020, interest rates were falling, which meant the government could lever up basically as much as they wanted. They could take on as much debt as they wanted, knowing that in a year, 2 years, 3 years, they could always just roll that debt over and the interest rate on the debt in the future would be cheaper. And so the cost of growing the debt was actually decreasing. It would cost less and less over time to have more and more debt. Many individuals do the exact same thing with their own debt. If you know that interest rates are gonna go down in the future, load up on debt right now, do all your spending in the present, get all of the stuff that you want right now, and you don't have to worry really about paying much for it, because in a couple of years, you refinance that debt by borrowing new debt and paying off the old debt, and now the cost of paying for that debt is way cheaper. Meanwhile, you're still getting raises, you're still getting promotions, you're getting new jobs, and so your income is going up. So both on an absolute standpoint and on a relative standpoint, your cost of servicing that debt gets cheaper over time, even though the total debt load is growing. And that's exactly what happens to the US government. But at a certain point, around 120%, you just can't keep on going anymore. You start to have problems like inflation, which we all know inflation burst onto the scene again in a very ugly fashion starting in 2020 when they printed $3 trillion out of nothing and spent that money into the economy. And the problem is once you're at 120% debt to GDP and interest rates are already at zero and inflation breaks out, you can't keep on going down that same playbook again. You can't just roll over the debt at a lower interest rate because rates were already at zero. And by the way, if you do that, you're injecting more money into the economy, which makes inflation go through the roof. That automatically by itself pushes interest rates higher because now lenders want to be compensated for that inflation that's happening. So they demand a higher interest rate in order to get compensated for that loss of purchasing power. Now, at the end of World War II, the last time we went through an inflationary deleveraging and went from 120% debt to GDP ratio all the way down to about 30, it was an inflationary deleveraging. The Federal Reserve engaged in yield curve control, which meant they pegged interest rates so that the government could borrow as much as they want and wouldn't have to worry about lenders not wanting to lend them that money. The Federal Reserve forced it to be lent at that rate, which meant that the government was borrowing at a rate that was lower than the rate of inflation. In other words, negative real interest rates. During this time, we also had a big productivity boom. As the population grew, men came home from war, people entered the workforce, and globalization took off underneath the Bretton Woods Agreement, producing cheap goods for the United States. All these factors came together, increasing the size of the GDP, even though interest rates were going up that whole time, as you can see from this chart, and inflation was going up that whole time. It still allowed the US government to deleverage relative to the size of the economy. Now, that is not the best way to deleverage. If a government instead will take the responsible route and they will deleverage through spending cuts, tax cuts essentially just getting smaller, allowing more freedom for the economy to flourish on its own, and it will stop hurting the currency, devaluing it through printing it into existence. It allows all the dead wood in the system to burn off. It undoes a lot of the malinvestment, and so a lot of the people who are relying on those money transfers, those zombie companies, the depreciation of the currency, that kind of stuff does die, and the ownership of all of those real assets gets transferred to the productive economy, laying the foundation for a very, very healthy and strong economy going forward. And many people were very hopeful the current administration would do exactly that, partly because that's one of the things that was campaigned on. For instance, the original promise from the Department of Governmental Efficiency was to cut government spending by $2 trillion. And now that expectation has been reduced to about $150 billion. Now, don't get me wrong, that cutting of $150 billion is a good thing. There's a lot of money that the government is spending that they shouldn't be spending. That's your money and that's my money. Those are dollars left in our pockets, and that is a good thing. It's also true that it's peanuts. Makes barely even a dent in what the US government is doing. We also know that the US military is one of the largest expense items for the US government, and Trump said that if he reached agreements with rival nations, the US could reduce runaway military spending by as much as 50%. Military spending is one of those categories that Congress gives the military more spending money than they even ask for basically every year. That's why it's called runaway spending. And in a complete 180-degree turn, Trump just promised $1 trillion in defense spending for next year, which is more than before, not anywhere near 50% less. In other words, this administration campaigned on getting rid of fraud, getting rid of waste, bringing back austerity and responsibility, and reducing the deficit. In other words, we pull a bunch of money in from taxes, we spend a bunch of money. The difference there is crazy right now. This is a chart of the surplus or the deficit from the US government. You can see that basically since 2001, it's been getting worse and worse and worse every single year. 2024, the deficit was a staggering $2 trillion. And many people were very hopeful that Trump would turn this ship around. Right now, we are at the halfway point of fiscal year 2025. And I get it, Trump has only been in office since January. But the spending has done the opposite of slow down. In fact, it's sped up. The current fiscal year to date deficit is at $1.3 trillion. You can see that is 23% higher than this exact same point last year. That puts us on pace for a 2025 deficit of $2.6 trillion. That's 9% of GDP. It's no wonder that interest rates on US government debt are moving higher. There are many things causing interest rates on government debt to move higher, but one of them is certainly the expectation that we are going to have increased inflation from all the government borrowing and spending that money into existence. The deficit is not shrinking, it is growing. The main reason for that right now is because of spending increases. But even if they slow down spending, you would also have to pair that without any tax cuts if you want to fix the deficit. And yet it seems that is one thing that this current administration is very, very focused on, is reducing tax income. Now again, I think that by itself is a great thing. Every dollar that the government cuts in taxes means that I get to keep more money in my wallet. I will do better things with my money than the government will. I'm not bombing children in Yemen. I'm investing in projects with a real return on investment. I'm improving the lives of people around me, and I'm giving money to businesses around me that are being productive. I'm giving to charity, helping homeless people, helping people that are hungry get fed. Again, I'm doing much better things with my money than the government ever could. So tax cuts are welcome. But if you think for 1 second that the government is turning the ship around and they are getting themselves into a better financial position, then you've got another thing coming. We are in a long-term debt cycle that cannot be turned around from replacing some government employees with some software programs. This is a long-term debt cycle, and we are in the midst of an inflationary deleveraging. That means higher prices over the coming decades. That means higher interest rates over the coming decades while the government deleverages. And it also means much higher asset prices because all that money has to go somewhere first. This is the Cantillon effect. New money first hits asset prices, then hits the prices of goods and services, and then hits the prices of wages. And certainly there are ups and downs. In any long-term cycle, there are short-term time periods where things move up and things move down. But over the long run, I would not be betting against the irresponsibility of a government that has been digging a hole for itself for over 100 years now. Because everybody in a position of power to do something is benefiting by that continuing, because it is a grift and they are transferring wealth away from the average taxpayer and the average earner to themselves. And so turning that ship around means cutting off their own lifeline. And not a single person in power who has the ability to push for something like that is going to. The good news is, if you are aware of this, you can take advantage of it. For instance, taking advantage of the bear markets that appear when they rarely do. Because while we will have volatility, asset prices will continue to move higher as the money supply increases by being borrowing and spent into existence. And if you don't know how to figure out which assets you should be buying right now and what price you should be buying them, in other words, you don't know how to figure out if a stock is actually on sale or not, just because it's fallen doesn't mean it's trading at a discount or at a good value. You have to be able to calculate those things. If you don't know how to do that, you need my bear market investing guide. This is only going to be useful while we're still in a bear market, and these can end super rapidly. I'm only going to have this fire sale on my bear market investing guide while the bear market lasts. So don't wait too long, because if you do, it'll be too late. It's linked in the description below. As always, thank you so much for watching. Have a great day.